Welcome, everybody. Welcome to the reverse mortgage webinar. My name is Lyman Jackson, and I'm here with the team from Financial Planning Solutions, Andrew Holmes, Maggie Dolan, Rick Fingerman, and Janet Friedman, as well as some other interested parties. And our featured speaker today is Stephen Pepe. Did I say that right,
You
Steve?
got it. Yeah.
Okay.
Good job.
And we host webinars this year pretty much every month. We're doing a different topic. So check out our website where you can see a list of upcoming webinars on different financial topics. You may find something that's helpful to you or useful. And of course, we're always available to talk with you further if you've got questions about some of the things that are discussed here. Today's webinar on reverse mortgages is a good place to be if you're concerned about where money is going to come from in retirement, or how you'll pay off debts in retirement, how you might prepare for unexpected health expenses, how divorce might affect you in retirement, as well as if you're thinking about purchasing a new home and you have concerns about that, best ways to do that. And some, of course, taxes are always involved with um, different transactions, especially if you're thinking about selling your home and you're starting to look at the big capital gains that might be involved there. Um, so all those things considered, if you have any of those concerns, you're in the right place. And Steve's going to walk us through uh, a number of different areas that address these concerns and why, in many cases, a reverse mortgage might be just the right thing. So I'm going to hand it over to you, Steve, and take it away. And oh, just before we do that, sorry, if you can hold your questions till the end, that would be great. You can either speak them at the end of the formal presentation or put them in the chat as we go along, and we'll be sure to try to address your questions. I think Steve's planning to talk for about 45 minutes, so there'll be time for questions and answers at that point. Now we can turn it over to Steve.
Thank you, Lyman. Thank you, everybody. Good afternoon. I'm going to turn off my video and try to share my screen here. And please let me know if there are any uh, uh, technical issues that we encounter here, but there should not be. So let's get this started. Slideshow. Thanks for bearing with me. Okay. Again, my name's Steve Pepe. I'm based out of Milford, Massachusetts. I've been a reverse mortgage originator, meaning a loan officer, for about 19 years. I was a reverse mortgage counselor prior to that, and I'm an attorney, though not practicing law, but this is my passion. This is what I love to do. A little bit of a legal disclosure we need to make that this is my license number up here. I am licensed in Massachusetts, New Hampshire, Rhode Island, and Virginia, but we're an industry that's regulated at the federal level and the state level too. So there can be some differences from state to state. So if you live or work in a different state than one of those four, then we'll have contact information for how to reach someone in one of those states. We're going to talk today. This isn't a terribly in-depth nuts and bolts explanation of reverse mortgages. We're going to do a overview of some of the high-level concepts to get everyone on equal footing. This is going to be more of a practical application conversation, talking about how you can apply this to real-world scenarios for yourself, for your clients. So for so many retirees, the traditional Social Security, pension, and retirement savings and investments just are not cutting it anymore as we live longer, as inflation hits, as there's market fluctuations. Typically, a person's home equity is at least half of their total net worth. And here in Massachusetts, home values just continue to rise. So that can certainly be the case. A home is really an illiquid asset. And so you can't really spend it unless you convert that asset into spendable cash. And so we sometimes call it your second, quote, portfolio hidden in plain sight. It's the house you live in, but it's also wealth you own, but it's illiquid wealth. And we're going to talk about how to monetize some of that today. All right. So this is a statistic that's a little bit old, but as of December 2023, homeowners age 62 and older had over $13 trillion in home equity. That's home equity. That's not home value. That's the equity after subtracting existing mortgage indebtedness against the homes these folks own. So look at the vast reservoir of wealth we're talking about here. When we're talking about reverse mortgages, most reverse mortgages are the federally insured variety. The federally insured variety is called the Home Equity Conversion Mortgage. The acronym we use in the reverse mortgage industry is HECM, HECM. And HECMs are 99% of all of the reverse mortgage market. There are a couple of proprietary programs in the market, but mostly when we're talking reverse mortgages, we're talking about HECMs. They've been around since I've been 16 years old. I am 51 right now. Over 1.2 million Americans have used HECM since the program's inception. And contrary to what a lot of people think that, they're just predatory and, a trap for the unwary. When the Consumer Finance Protection Bureau, the CFPB, issues reports of how many complaints they receive are mortgage-related complaints, 1.6% of them last year were reverse mortgage related, and this year that just ended, it was a similar amount. So not much of a difference from there. Little bit of reverse mortgage 101. So a reverse mortgage is a kind of home equity loan, folks. And it's a home equity loan you can only take out on your primary residence, not a second home, not a vacation home, commercial property, only a primary residence. And it's a home equity loan with a minimum qualifying age, depending on the program. We'll go over those in a minute. A reverse mortgage, unlike most other kinds of consumer debt, is a mortgage loan that has no mandatory monthly repayment obligation, meaning you're not making a principal or interest payment back to your lender. You are responsible for keeping up with your real estate taxes, homeowners insurance, maintenance, condo fees if you live in a condo. And the repayment of any reverse mortgage is deferred until a maturity event. And a maturity event would be you selling your house, you pass away. If there are two or more of you that are owners, you both pass away, or you move out for more than 12 consecutive months because of a health-related reason. Barring one of those three things, there's no required repayment. So if there's no required repayment on a loan where a lender's charging you interest, you're going to have an increasing balance over time. And that's what we mean by it is a negative amortizing loan. It means the balance increases, gets larger. The analogy I use is like a tab at a restaurant. It just keeps getting larger and larger. And reverse mortgages, if you live in Massachusetts, this is a state law, and with the HECM program, this is the same nationwide. They are non-recourse, meaning that when one of those maturity events happens, neither the client nor the client's estate is responsible for owing more than that future value of the property when the reverse mortgage is being repaid. We have an example of that coming up really quickly. What types of properties are eligible for reverse mortgages? Single-family homes, the most straightforward. Condos meeting certain requirements. I won't get into more detail than that unless people have questions at the end. A planned unit development, 2 to 4 family homes that are owner occupied. And manufactured homes, meaning mobile homes, meeting certain HUD guidelines. And the big one is built after 1976, permanently affixed to the ground, and sitting on land you own and do not rent. So you cannot have a mobile home sitting in a park where you're paying a rental fee for the little piece of land your mobile home sits on. Has to be a mobile home on a piece of property you own. There's a few of those former types of communities in Massachusetts, retirement communities, where you rent the land and you cannot borrow a reverse mortgage on those. What types of homeowners are eligible? So for the HECM program, you have to be at least 62. If their spouses own a property, at least one of them has to be 62. My company, Longbridge, has a proprietary reverse mortgage that has minimum ages to qualify as low as 55, depending on the state. In Massachusetts, it's 60 is the minimum age for the Platinum program. You must own the home and live there as your primary residence. You've got to demonstrate you've got income to be able to keep current with your taxes, insurance, maintenance, and condo dues. And you must have sufficient equity in your home, meaning if you have a mortgage or a HELOC or liens on your property, we've got to be able to lend you enough money to pay that mortgage off in its entirety and have something left over. A couple key terms to review. Principal limit factor. This relates to how much money can a lender lend you. So the principal limit factor is based on a formula that takes into account the youngest homeowner's age, the loan's interest rate, and the value of your home. Those three things are entered into a formula, and out the other side comes a principal limit, or an amount your lender can lend you. It's not a matter of how is your income, what's your credit score. Those things don't matter for determining your loan size. Another key term is the maximum claim amount, or MCA. And for the HECM program, this is the highest amount the FHA will insure on a reverse mortgage. Put another way, when we're doing that principal limit factor calculation, the PLF calculation above, and we're plugging in a home value for the HECM, there's a cap at how much home value we can use. For 2025, that cap is this $1,209,750 figure right there. So for example, if a homeowner goes to a lender to apply for a HECM and they own a $1.5 million house, when doing that PLF calculation, the lender has to treat that person's house as if it's worth that $1,209,750. But if their home is worth $500,000, then they can put in the full $500,000. It's for this reason that there's this limit on the HECM program that lenders like our company came up with non-HECM programs, that one of the niches they serve in the market is that of a jumbo reverse mortgage, because there is no cap on home value with those proprietary jumbo products. So that same person goes shopping for a jumbo reverse mortgage and they have a $1.5 million property. The lender can look at all $1.5 million when doing that PLF calculation. For the Longbridge Platinum program, we can look at anything over $4 million, up to $4 million. All right. With a HECM, there are several ways to withdraw money from it. Most people think you have to just take everything in a lump sum, and that is only true for a fixed interest rate HECM. HECMs come in two flavors: fixed interest rates and adjustable interest rates. A fixed interest rate HECM, you have to take all of the funds in a lump sum. But for a variable rate HECM, you have all of these other options. You have a line of credit that grows, and we'll see that in examples. You can take fixed monthly advances for your lifetime or for a term certain. You can take a lump sum of a portion, so like to pay off credit card debt or a small balance on a mortgage or a car loan, or you can do a combination of two or all three of these things. Couple other highlights of the HECM program, because it's almost every reverse mortgage that's out there. It cannot be reduced, called, or canceled as long as the terms of the loan are met. The terms of the loan are paying taxes, insurance, condo fees. A HELOC, a home equity line of credit, your line can be reduced, called, or canceled if your lender is concerned about property values decreasing. But with a HECM, a lender cannot do that. You can use one to buy a new residence. We have that as an example. There's that non-recourse protection. And again, no repayment unless someone sells, passes away, or moves out for more than 12 consecutive months for health reasons. A quick blurb on Platinum. Again, we can look at homes up to $4 million. There is no government mortgage insurance premium piece with a Platinum that exists with the HECM program. So a lot of times the finance closing costs are less. There's no prepayment penalties, just like with a HECM. Same non-recourse protection. Easier to get a Platinum on a condo. Faster to get a Platinum approved than a HECM. And it can go down to age 55 as the minimum qualifying age. Again, it's 60 in Massachusetts. Let's talk a minute about non-recourse and what this means. So here's an example. We've got someone with a $500,000 home, and they go to a lender and set up a HECM with a $300,000 line of credit. And then soon thereafter, the value of their home drops. We're going to get extreme and say, over a period of time, their home drops in value to $100,000 from $500,000. Okay. Even if they have a $100,000 home value at some future point in time, that $300,000 line of credit remains intact. Again, it can't be reduced inside, called, canceled, anything like that. Okay. With a HELOC, you can. With a HECM, it cannot. So then you've got this homeowner with this $100,000 home value and a $300,000 line of credit, and they decide they want to withdraw it for some reason. Can they? Yes, they absolutely can. There's nothing the lender can do about it. So this person withdraws their $300,000 from their HECM line of credit. Then a month later, this same client sells their home for the fair market value of $100,000. That's what it's worth. At that closing table, their lender will be cut a check for $100,000, the value of the home, but they owe another $200,000 on the debt, but the borrower is not responsible for repaying that debt. On a HECM, the FHA mortgage insurance, FHA is Federal Housing Administration. The FHA mortgage insurance pays a claim out to the lender for that $200,000. So it's not canceled debt, so there is no income tax consequence here. It is repaid. It's just repaid through insurance coverage. So this is a very unique protection that HECMs have that no other kind of commercially available mortgage or HELOC has. The government insurance that allows for this non-recourse protection, it can be pricey. Admittedly, it's more pricey than a regular mortgage, but it offers a unique protection that no other mortgage has. All right, so that's enough about high level basics of the program. Let's roll up our sleeves where the rubber meets the road and talk about some 6 practical applications of using these loans for different scenarios. So I've spoken to thousands of people over the 20 plus years I've been in this industry, and I've personally encountered all 6 of these scenarios with people I speak to. So even if these scenarios don't describe you, they might describe your parent, they might describe your client. So I think it's a worthy use of your time today, hearing me out on these things. So scenario number 1, decreased liquidity caused by either a decrease in income and or a decrease in expenses. So left side of this, decrease in income, like illness, like COVID, like any other illness we encounter, especially in older age. The death of a spouse, which can cause a drop in net Social Security to the household, a drop in earned income to the household if that spouse was working, or maybe a spouse chose a pension that did not have a survivor benefit to it, and then they pass away, and then so that complete pension income ends, right? Exhaustion of IRA or 401k funds, either through poor performance or just longevity, living longer and using it all. Institutionalization of a spouse, talking about a skilled nursing facility or an assisted living facility. Not only are those very expensive if you're paying out of pocket for a private bed, but let's say you have Medicaid paying for a bed, which is Mass Health in Massachusetts. If Mass Health is paying for your spouse, there's an element called the patient paid amount, where that spouse's income automatically gets diverted to the institution. It's not going to the community spouse. And the community spouse has limitations on how much in resources they can own to keep their institutionalized spouse Medicaid eligible. So there's a term that's really gaining popularity on the elder law bar, community spouse impoverishment. So this can be used to mitigate that. And a decrease in part-time work hours, especially if someone is in the service or entertainment business as a retiree or semi-retiree post-COVID. Lots of reductions in work hours for folks like that. On the other side, increases in income and expenses. One that's not here, because this slide was created before it really took off, was inflation, right? Just the inflationary environment over the last couple of years. Home equity line of credit payment conversion from an interest-only payment to a fully amortized principal and interest payment. Private pay in home care, home repairs, car repairs, emergencies, caring for an adult disabled child, becoming the guardian of a grandchild. So these are all increases in expenses. These are the things that will cause faster erosion of a retirement portfolio and an increased chance of someone outliving their money. It results in heavier reliance on other consumer debt that carries mandatory minimum monthly payments and higher interest rates. And it also causes more reliance on younger relatives who might be helping mom or dad, but then they have to divert cash to their parents and away from their own retirement savings, their own college savings plans for those kids, the sandwich generation, right? Living parents and kids. And these things result in overall diminished standard of living. So what are potential solutions to this? Something called a tenure disbursement with a HECM and something called a modified term with a line of credit. So we're going to look at both of those right now. This is the tenure scenario. So a tenure payment with a HECM is a monthly payment coming to the borrower for their lifetime as long as they live in the home, guaranteed by the federal government, will not be stopped because the home goes down in value. It can't stop for as long as you live in the home, pay your taxes, insurance, condo fees. I say this walks like an annuity, quacks like an annuity. It's not an annuity. It's debt. It is a loan that has to be repaid when one of those maturity events happens. But it is cash flow that is not taxable. So in this example, two spouses, both 62, living in a home are $775,000 today in Massachusetts. They set up a reverse mortgage and take a 10-year payment. That would be approximately $1,375 a month for as long as at least one of those spouses is living there. So they set it up for $1,375 a month. Tragically, the husband dies after the second month. The wife will continue, or the other spouse will continue to receive $1,375 a month for their lifetime as long as they live in the home. That's $495,000 over 30 years if the survivor lives that long. Okay, it's a lot of money they can receive. So if they were older when they initiated this, let's say at say 70 or 75, this would be a larger tenure payment than the $1,375 a month. Because again, that PLF calculation, it's based on the age of the youngest spouse. The older you are at inception, the more money the lender can lend you. So therefore, the larger the tenure payment would be. All right. This is that term payment with the line of credit. We call that a modified term payment in my industry. So same, let's take this same couple, 62 years old. Another way they could structure this is, let's say, for example, they're still working. They could set up a monthly payment coming to them between the age of 62 and then 70, and then have that monthly payment stop. That's called a term payment, a monthly payment that stops at a term certain in the future. So in this example, they set it up to receive $2,500 a month until age 70 so that they can wait until beyond their full retirement age to then claim Social Security. That's the fictional scenario I'm making up here. So they can get that 8% a year bump beyond full retirement age. And in addition to the $2,500 a month, at the inception of the loan, there would be a line of credit of $44,509 that the federal government says, guess what? We're guaranteeing that this available line of credit will grow over time. And the chart on the right shows growth. If they left that $44,000 line of credit alone, what it would potentially grow to over time. At age 80, over $145,000. Okay, so if they, instead of taking a term payment until age 70, they took a term payment until age 67. Let's say 67 was their full retirement age. That line of credit would about double. That line of credit would be a $90,000 line of credit instead of a $44,000 line. All right, problem number 2. Carrying high interest and large consumer debt of other flavors. Other flavors meaning debts that have mandatory required repayments at a time in your life when you are on a fixed income because you are retired or you're quickly approaching retirement. Okay. So we're talking about debt burdens like existing mortgage debt, HELOC debt, substantial credit card debt with very high interest rates. This is a big one with inflation. This is how a lot of people are coping with inflation right now, is leaning on their credit cards. I understand. I totally understand it. But it gets precarious when you're on a fixed income, right? Auto loans, RV loans, boat loans, student loans for which an older homeowner co-signed for a younger relative like a child or a grandchild. This causes a negative impact on one's retirement portfolio and retirement income. So it might lead to excessive portfolio withdrawals to keep up with meeting these minimum monthly payments, which then triggers a tax burden. It can accelerate portfolio depletion and increase the risk of fiscal crisis and a smaller safety net for emergencies. So we're going to look at a couple scenarios here. Paying off that existing mortgage and HELOC debt and other types of debts with a reverse mortgage, and combining that with a line of credit or combining that with monthly tenure payments or term payments. Okay, let's look at a couple of those scenarios. So this is a very common scenario. You've got a 7-year-old with a $700,000 house and $200,000 in mortgage debt. Let's say they have a $150,000 first mortgage and a $50,000 HELOC, home equity line of credit. What a HECM would enable them to do is pay off the $200,000 in mortgage debt and establish a line of credit of almost $50,000 at the outset, thereby eliminating that monthly principal and interest payment they are required to make on those two mortgages we just wiped out. No more principal and interest on the first mortgage, no more interest or principal and interest on the HELOC, depending on how old it is. And then you have this available line of credit that, again, Uncle Sam says this is guaranteed to grow. And that chart on the right shows the growth rate over time. So your clients are not immortal and they're not indestructible. Mortgage lenders cannot discriminate against an applicant based on age or disability, and that is an excellent thing. There are very important discrimination laws in place to prevent that kind of thing. However, people in retirement are more prone to have health challenges arise that lead to substantial out-of-pocket expenses. And if they are married, that is the time of life where you're more likely to lose a spouse. So I observe every day situations where a well-meaning lender puts a mortgage loan or a HELOC in place for someone in their late 50s, 60s, 70s, even 80s, but at a time of their life where they're least likely to be able to afford it. And then you throw in one of those other life events, like a major health event or the death of a spouse, and then it's absolute disaster. So that's why I personally am unapologetically anti-HELOC and even anti-traditional mortgage for people who are retired because of this trap. That is my personal opinion. You might disagree with me, but I just see the consequences every day of what happens. Here's another scenario, 70-year-old with a $500,000 home and no mortgage, but this person has a $20,000 auto loan, $20,000 in credit card debt, and they co-signed a student loan with their grandkid for $10,000. And a lot of times that grandkid defaults on the loan, and then it causes credit problems for the older client. So here's a scenario of 3 ways we could configure a HECM. One way, a $50,000 lump sum at the closing to pay off auto loan, credit card, and student loan, and also set up an $817 a month tenure payment for this person, or $50,000 lump sum disbursement with a smaller tenure payment of $500 a month and a line of credit of $46,665. Remember that slide a few slides back? You can do a combo of different disbursement options. Or a $50,000 lump sum and a $120,000 line of credit. Look at how neat and efficient this is in terms of swinging the pendulum of cash flow from potentially negative to way positive. And I'd add the comment, does this look like what a stigma reverse mortgages so often have? It is a product of last resort. Does this look like a product of last resort? No, this looks like wise utilization of home equity to pay off other types of consumer debt that are impacting cash flow. Changing healthcare needs. So left side, your basic medical care. We're talking about care in the home or care with maybe part of a day in a facility. You've got Medicare, PACE, aid and attendance benefit, private insurance, Medigap policies, things like that, paying for doctors, nurses, hospitalization, some durable medical equipment, that's covered through those programs. But additional expenses associated with, and that go in tandem with healthcare and staying at home and receiving care, are assistance with your activities of daily living, getting shopping, errands, housekeeping done, making accessibility modifications to the house, wheelchair ramps, stair lifts, walk-in tubs, other durable medical equipment, modifications to your transportation like a van, etc. That's out of pocket. You're self-funding unless you have long-term care insurance. And even if you do have LTCI, you still might be self-funding out of pocket as well. So couple possible solutions with a HECM. We're going to talk about a term payment solution and a line of credit solution. So this is what I call the in-home care acute needs scenario. Too often I'm called in this scenario, and I wish I was called in the next scenario, but let's look at this scenario. 90-year-old in an $800,000 home, no mortgage, and they've burned through all of their retirement savings they've had because they're receiving in-home care from an agency, and they or their kid is writing a check for Massachusetts $20,000, $25,000, $30,000 a month. Okay. If this 90-year-old set up a brand new HECM, they could receive $20,703 a month for almost 2 years. So a HECM would get them 2 more years in the home, using home equity to pay that home care agency at the rate of $20,000 a year, $20,000 a month. Or they could establish a $445,000 line of credit. And not getting too much into it, the federal government limits how much a borrower can access in the first year. So this 90-year-old would be able to access up to $256,000 in the first year. So that's the acute need. Oh my gosh, I've used up all of my other savings. I don't want to leave. I'm going to turn to my home equity because I've used everything else. That's that last resort mentality. All right. But don't underestimate the pull and the desire to remain at the home and the impact it has on all kinds of decisions like financial decisions. Okay. This plan that we're looking at here, it's compatible with other asset protection strategies and estate planning strategies that my brothers and sisters of the elder law bar use all the time, like trusts, life estates. It's compatible with all of those things. Okay. Couple other things to note, the calls, the incoming calls for this scenario, it's not coming from the 90-year-old. It's coming from their kid. And the kids are super stressed out, and the kids might be writing those $20,000 checks from their own pocket to keep mom and dad in the home. And that means they're not saving that $20,000 a month for themselves. Right? So this is affecting everyone. This is multi-generational impact on these kinds of emergency scenarios. This is my favorite slide in the whole deck and my favorite utilization of the HECM program. I wrote an article for a financial planning journal and a law journal on utilizing a HECM this way. And this is the planning ahead strategy. This is the long-term care insurance in quotes 2.0 for people who don't have an LTCI policy, or even for those who do have an LTCI policy, and this can supercharge it. So this is the strategy. You set up a HECM line of credit as young as you can, as early as you can, if you are a homeowner and plan on staying in your home as your forever home. So this person's 62 in an $800,000 home with no mortgage. They can establish a HECM line of credit of almost $227,000, and the federal government guarantees it will grow over time. They could be healthy, working. They don't They could have $2 million in savings and investments. Okay. I don't care. That in-home care that is $20,000 or $30,000 a month today, what is it going to be in 20 years, right? In the year 2045, when they're 82 and they've had a health setback. This sets up that reservoir, that giant bucket that can be almost 1.8 million by age 90. Look at that $1.8 million figure compared to the last slide, the 90-year-old who came to me only after spending everything first. We could get that person $445,000 in 2 years in the house. This person, we can probably get them several years in the house, whatever the future cost of care is going to be. Let's compare this to a long-term care policy. No out-of-pocket premiums, no elimination period, no health underwriting, no required declaration by a doctor that the person needs assistance with activities of daily living. This plan is not portable like a long-term care policy is. So if someone moves, then this line of credit goes away because the HECM has to be paid off. All right. Again, this has been around since I've been 16. I'm 51. Very few people are utilizing this strategy. And I think more people really should. All right. Next problem, sequence of return risk. So this is when you have a retirement, you're retired, you're in the distribution or decumulation phase of your retirement plan, and you are having a down market and poorly performing assets. And the others on this call, not me, can share with you the impact that can have on the longevity of their portfolio and their spending, and will they outlive their money or not. So the strategy is all about using home equity as a buffer asset in bad markets, rather than selling market positions at a loss or having to withdraw those assets to create liquidity for the client. So it leaves those investments intact during a down market so that they have an opportunity to appreciate in the future in an up market. You coordinate setting up a HECM line of credit, and in down markets, when portfolio is not performing well, leaning on the home equity to solve the client's cash flow needs. Pull money out of the HECM line of credit for cash flow. Don't liquidate assets. And then when the market improves and investments are performing better, the client always has the option of then prepaying the balance on the reverse mortgage by liquidating assets, then paying down the balance and then restoring the line of credit so that they can pull it out again in the future. Professor Wade Pfau of the American College wrote a book on this, and he goes into excruciating detail on how to do it, and he does it in financial planner speak. And anyone who wants a copy of the book can contact me afterwards, and I'll gladly send you a free copy. But I'm not going to pretend to explain the scenario better than Wade can, because he's the expert. He ran the scenarios. Here's what it might look like: a 65-year-old with $1 million home and no mortgage lien, $306,000 line of credit as that buffer asset to lean on in the down markets, and the line of credit grows. I haven't mentioned it yet, but people are probably wondering, at what rate does that line of credit grow? So it's not a rate you can peg that it's a particular percentage we can predict. The growth rate on the line of credit is equal to whatever interest rate your lender is charging you plus 0.5%. So if your reverse mortgage interest rate is 6.5% today, so any money you withdraw, your lender's charging you 6.5%, your untapped line of credit is growing at 7%. And that's a federally controlled formula. That's nationwide, that's industry-wide. This is a pretty picture. a unified HECM strategy for portfolio preservation. So 65-year-old client with $1 million home, let's say they have a $40,000 HELOC and $10,000 in credit card debt. We can do all three boxes pictured here. We can do a $50,000 lump sum to pay off the HELOC and pay off the credit card debt. And for this client, set up a $2,500 a month term payment until this person turns 70 beyond full retirement age so they can get the 8% per year bump and maximize their Social Security benefit, and have a $181,000 line of credit at inception that can be that buffer asset for down markets. That's that sequence of return mitigation, or to let it grow for future in-home care needs. Beautiful. Again, not a product of last resort. This can be used very strategically even for more affluent clients. Gray divorce, we're going to talk about a couple scenarios here. I know I'm getting short on time. Here's how a reverse can be used for two older people divorcing. One spouse can buy out another spouse using a reverse mortgage and stay in the marital home. The spouse who stays in the marital home can use a reverse mortgage to increase their cash flow and supplement their income. That's that tenure payment or term payment. The departing spouse can use a reverse mortgage to buy a new residence. That's going to be our last scenario. The spouse who stays in the marital home or even moves to a new marital home, not marital home, moves to a new home, sorry, can get a reverse mortgage if they then have obligatory alimony payments or child support payments for a child or a grandchild. Unless the NISI period is expired and the people are forever permanently divorced, but you're going to need both spouses' cooperation. So if they're separated and not divorced, you better hope that your separated spouse will cooperate with you in filling out the paperwork. Let's look at a few of these scenarios. 68-year-old with an $800,000 home. They could get a lump sum payout of $276,000 to buy out the other spouse's interest in the home. Notice that is not 50%. It's less than 50%. So you got to keep that in mind if you're using this and negotiating with the other spouse on what's going to be that buyout price. This product in today's interest rate environment will not get you to 50% if you're 68 years old. You've got to be about 87 years old to get to 50% debt to loan to value. Few HECM scenarios for the remaining spouse. 68-year-old client with an $800,000 home just got divorced. If they want to stay there and that's their forever home, they could get a monthly tenure disbursement of $1,794 a month for life as long as they live there, or $1,000 a month and a $120,000 line of credit. That grows. Or if they're going to stay in the marital home for a short term until they get their feet underneath them and restore their credit and build up some reserves, but they know they're going to sell in a few years, this can be a short-term solution. And here's where they could go with, say, that term payment, say $4,000 a month for 5 years and a $69,000 line of credit. And then maybe they're going to move in 5 years. Okay, just another scenario to show you. And then finally, we're going to talk about using this to buy a new home. Most people, even most realtors, don't know you can use a reverse mortgage to buy a new principal residence. For a HECM, you've got to be at least 62. For Platinum, it's 55 or 60 in Massachusetts. The proceeds of the reverse mortgage funds are combined with your one down payment investment. The two combined, your down payment and the reverse mortgage proceeds, are what enable you to buy the home. And because it's a reverse mortgage, you have no monthly payment obligation. It's got to be a new primary residence. It can't be a vacation home. So let's see this put into practice. So the gray column is without a HECM, and the green column is with a HECM if you're buying. So this is a 72-year-old looking to sell $1.5 million property and downsize to an $800,000 home, but they don't want a mortgage payment. So the left column, the gray column, is the typical scenario everyone would ordinarily use. Sell the home for $1.5 million, pay the realtor and the seller closing costs, you net $1.38 million. You're going to buy a new home for $800,000. Your buyer-related closing costs approximately $7,700. So you have to come up with $8,077 of your proceeds from the sale of your departure home in order to be an all-cash buyer of your new home. After you part with all of that cash, you have $572,000 in cash remaining that you give to your financial advisor to put to work for you. And 10 years, that might grow to $983,000. I call that scenario the good scenario. Now let's look at the great scenario. The great scenario is the right column, using the HECM for purchase. Same $1.5 million purchase, same net after paying the realtor and the closing costs, same purchase price. Closing costs might be around $56,65 approximately. With this, the person has $332,000 in reverse mortgage proceeds that they can contribute. So therefore, they are only parting with $492,000 of sale proceeds from the departure home. They combine that with the reverse mortgage, and they now have $887,000, almost $888,000 in cash after the purchase of the new home that they give to their financial planner. That is a much better scenario in terms of liquidity after the purchase and reserves after the purchase. Every realtor is going to steer you to the gray column because they want an all-cash purchase with no financing contingency. But it does not mean it's the right solution for you or your client, as we can see from this chart. And then one other scenario for buying a more modestly priced house, 65-year-old and wants to relocate and buy a $500,000 home with no mortgage payment. Let's say they're selling a $600,000 home. They want to buy a $500,000 home. Doing the math, after closing costs and things, they would have about $46,700 remaining in sale proceeds after moving into the new home. I call that the good scenario. The great scenario is using the HECM. Again, selling a $600,000 home, buying a $500,000 home. This time the HECM is making up financing part of the purchase price. And they are left over $222,000 as opposed to $46,000. Much better cash flow reserve scenario with no monthly mortgage payment because it's a reverse mortgage. I'm going to stop there. I'm going to stop sharing my screen. But this is how you can reach me if you have any questions or you want a copy of Wade Fowle's book. If you live in any of these states, give me a call, shoot me an email. I can be on for as long as we need or as long as time as we have to answer any and all questions.
Steve, there's a
yes.
couple of questions that came in the chat.
Yep.
First was, what's the average expense of setting up a line of credit?
Sure. So average expense on setting up a line of credit, there are finance closing costs that are in three categories. With a HECM, there's a government mortgage insurance premium as part of your closing costs, and that's 2% of the appraised value of your home. So if it's a $500,000 home, 2% of that is $10,000 as a one-time government insurance premium up front. In addition to that, there's your typical closing costs that a person would have with any mortgage transaction, and depending on the value of your property, that might be about $3,000 to $6,000. And then the final category of closing costs is something called a financed origination fee that a lender can charge. That can be anywhere from, again, depending on the value of the home, about $3,000 to $6,000. So these closing costs, depending on the value of your home, but a typical Massachusetts home, it might be anywhere from, say, 16 or 17,000 to, in the low 30s for properties worth north of $1 million. The proprietary products are worth cost about half that. Those are finance closing costs unless you choose to pay them out of pocket. The only exception is a lender can ask you to pay for the cost of the appraisal out of pocket. And there's a cost for what's called a reverse mortgage counseling session, which can be a couple $100. So those are the costs for setting them up.
The other question was, are there any expenses or charges for a line of credit that isn't being utilized?
No, just interest, accruing interest in a small amount of government annual mortgage insurance, accruing on whatever your outstanding balance is. So if someone sets up the line of credit and financed their closing costs, and those closing costs were $25,000, there's interest and then 0.5% per year of government mortgage insurance accruing on that $25,000 beginning balance. But that is the only cost of the reverse mortgage going forward. If the line of credit is or isn't utilized. So there's nothing, no other fee or anything charged for an unutilized line of credit.
Hey, Steve, I see another question I think is similar. It says if one sets up a HECM but never draws on it and sells the house, what's the downside? And do they receive 100% of the sale proceeds like in a traditional sale?
So there will be, if they finance the closing costs, then there is going to be a mortgage balance of whatever those initial closing costs are. And then however many years of interest and government insurance added on to that balance. So back to that $25,000 in closing cost scenario. If they set that up, never use a line of credit, and then sold the home, there will be a balance. Maybe that balance is 30,000 or 31,000 or 40,000 or something. That gets paid off at the closing. The realtor gets paid, and then seller closing costs, and then they get a check for the rest. If they choose to pay the closing costs out of pocket to keep that increasing balance from happening, they can. You just need to have at least about $100 balance open on your reverse mortgage to keep the line of credit available.
Okay. And the other question was, is their credit looked at in a HECM like in a traditional loan when applying? Or is it just the equity in the house?
Credit is looked at, unlike when I got into this business, it was not. It is looked at, but on a much more limited scope than on a traditional mortgage. So for the HECM program, there's no FICO score requirements. Credit is examined for the purpose of, we look at the immediate 2 years preceding the date you apply, and we see, were there any 30, 60, or 90-day late payments on your credit report for like credit cards, car loans, mortgages? If so, what were the circumstances? How many? Were you ever late paying your real estate taxes, homeowners insurance, condo fee? If the answer to those questions are yes, then it doesn't mean you're going to be disqualified. But what it means is your lender might be compelled to take over the responsibility of paying your future real estate taxes and homeowners insurance for the rest of your life expectancy. And what we do is we earmark a portion of your line of credit for the purpose of paying your future taxes and insurance. We say, okay, customer, we have to carve out this for your taxes and insurance because you've been late on paying taxes or insurance or late paying your mortgage. You can use the rest of the money on anything else. We're paying your taxes and insurance out of this money we earmarked. And that's the extent of what we're looking at for credit. Credit problems won't give you worse rates or terms. It won't give you a higher interest rate, higher closing costs, anything like that. With the proprietary programs, there will be a FICO score minimum, depending on the lender and other factors. So.
Great. We have one last question that came in. Can you keep your first home after doing the HECM bit for a retirement home? And what's the risk?
It's got to be your primary residence. So if you get a reverse mortgage on that home, it's going to be where you're, barring a medical reason why you might be absent for more than 12 consecutive months. If it's just you're healthy and you're in retirement and you have two homes, the home where the reverse mortgage is where you've got to be at least 6 months out of the year at. It's got to be where, the address reflected on your ID, your bank account, your tax returns, where you're registered to vote. Lenders have ways of looking into those things and verifying those things. So you don't want to set this up on a residence and then move out of that residence and move to the Florida condo and then come back between, Thanksgiving and New Year's back to Massachusetts. So just be mindful of that. That's a dangerous game.
Okay, great. So we're coming up on the hour. If anybody has any additional questions they didn't get to ask, feel free to reach out to us. If we don't know the answer, we'll reach out to Steve and get back to you. Thanks for joining us today.
Thank you.